Hello everyone and welcome to our sessions on Japanese candlesticks. My name is Merlin Rothfeld, excited to be with you today. One of my favorite topics in trading is actually looking at candlesticks. And when we look at those on a price chart, it's rather simple. We see all these colored little bars out there, but what do they actually tell us? Well, I'm going to start off by going back through history and looking at how these came to be, why they're so important, and why they are so much more than just reading price. It's really a behavioral analysis tool, and we can start to understand how buyers and sellers are thinking and the emotions behind that. That gives us a competitive advantage. Now, we're streaming live out there today, so we'll be watching your chat as it comes through here today. So please feel free to keep on typing in your chat and questions as we go, and I'll try to get to all those. Now, as a quick little precursor here, of course, we've got a disclaimer there. I'm going to do like one of those car sales guys and read through it very, very quickly. No, I'm not. I'll just let you guys read it at your own leisure. So let's go and start off with a basic example. Something we all remember from our elementary school or camp days, a tug-of-war battle. Well, when we look at Japanese candlesticks, I want you guys to understand that it's basically a tug-of-war battle. Every candle starts out at an even point. There's no winner, there's no loser. But as that battle progresses, and you look here, we've got two guys on the left-hand side, we've got two lovely ladies on the right-hand side, we can start to base our assumptions about what's going to happen. And, and lo and behold, we go here and we get back to that one. There you go. You see all of a sudden the guys are just crushing it, right? They're pulling, they're getting the girls almost all the way past that line, so they're just about to win. But the battle's not over yet. And for whatever reason, whatever circumstance, those girls just dig deep. They plant those heels, and all of a sudden they start pulling and pulling and pulling, and they start to win this battle. And at the end of it all, when the bell rings, when the whistle blows, the girls have won this battle. So regardless of what your preconceived notions were going into this battle, there was a period of time where the men were winning, there was a period of time where the women won, but ultimately at the end of all of this, the ladies won. And that tells us a little bit about the psychology going into that situation. So that's kind of how we're going to focus on this. I want you to think of it as a battle, a war between participants. Now, in the real world, it's not about you and me or any other specific trader. It's all of us combined. So how did it all start? Well, we can go way back to the early days here. This is what's called the Dojima rice market. And really in 1710 is when they went to a futures market, because it used to be kind of a actual hand-on rice type of market until 1710. And then it went to a futures type of exchange. And this is a classic picture we found of the Dojima rice market. Now, one of the traders that emerged from that, and it really is kind of known as the father of Japanese candlesticks, is a gentleman by the name of Hama Manahisa. Again, I put on there, the father of Japanese candlesticks. I'm pretty sure he's actually an honorary samurai, by the way, just for those who want to know. Because he was so good at Japanese candlesticks and trading, they made him an honorary samurai. And I don't know about you, but I'm thinking an honorary samurai should be able to swing a sword pretty good. But well, maybe he could. 1724 to 1803 was his lifespan there. And I want to bring up a quote here that some of you might attribute to another famous investor out there. There's one that people look at Warren Buffett and say, that's Warren Buffett's phrase. No. It's Hama Manahisa. And he says, when all are bearish, there is cause for price to rise. When everyone is bullish, there is cause for price to fall. And this goes back to kind of the Warren Buffett one where he says, when there's blood in the streets, that's when you want to be buying. And when everyone's getting really excited, that's when you want to get out. Pretty much says the same thing, right? But just a couple hundred years earlier. So let's walk through the very basics. Now, some of you might be familiar with Japanese candlesticks. Some of you might be brand new to this. It's okay. We'll start off with the very basics. Then I'm going to show you some more common patterns. And then I'll show you actually on real charts what these formations look like. So we'll start off with this basic illustration here, which really shows us a bar chart. This is not a candlestick chart quite yet. Now, every bar of information really gives us 5 pieces of information. And of course, you're looking at this going, I only see 4 words on each one. Well, the left hash mark there represents where it opened. You can see the low, you can see the high, and you can see the right hash mark is where it closed at. So those are your 4 pieces, but there's one more, which would be the range, and that's simply the distance between the high and the low. Those 5 components are what make up all bars and candles, and they give us a good insight as to what's going on with price and psychology. Now, if it opened lower, if it closed higher than it opened, then you're going to see an example of what we have on the left here, which is a bullish candle, which would be a white real body. And then if it closed lower than it opened, you'd have a black real body. Now, the way that Japanese candlesticks were traditionally done were in black and white. Nowadays, it's changed to red and green, which is somewhat ironic because trading is pretty much a male-dominated world, and is definitely changing, and happy to see that, but still predominantly men are traders out there, and it's red and green, which I believe something like 19% of men are colorblind to red and green. Could we have picked different colors? All right, the real body is the piece that was just colored in here, and that basically takes the difference between where it opened and where it closed, and based off what those numbers are, it will either make it white or black, or red or green. Now, the white candle obviously is going to be green for up, and your black candle would be red, meaning it closed lower than where it opened. Those are the very, very basics of candles. So we can start by looking at this chart here. Doesn't matter what security this is or what time frame it is, but you guys can see we've got a lot of black and white candles there. And very clearly, when we get a nice streak of black candles out there, it gives us that kind of negative connotation. We feel like there's a downside move there. You see some where there's a lot of white candles in a row, and that leads us to nice bullish moves. Well, most platforms now will look like this, with mostly red and green candles. Now, of course, we can change these to fit our color scheme at home. I like to use black and white candles simply because it's easier for me to see because I'm part of that 19% who's colorblind. Now let's break up the individual candles, right? You got a basic understanding. They represent buyers out there, they represent sellers, and we get 5 pieces of information. Here is where we want to start to focus on the psychology of candlesticks. So here we've got 2 candles, one showing buying pressure, one showing selling pressure. And you're wondering, well, why does that one on the left show buying pressure? Well, if you'll notice, the candle on the left is a white candle, meaning that it opened at the bottom of that white box and closed at the dead high. So that's kind of bullish, right? But more important is what happened during that range. So take a peek at this. During this time frame, let's say this candle represents 1 day of trading. You can see the price was aggressively selling off. At one point, this was a giant black or red candle because it would sold all the way down to those lows. But going back to our tug-of-war analogy, this is just like what we saw at the opening of this presentation. The buyers came back in, and for whatever reason, you could explain it till you're blue in the face, doesn't matter. The buyers came back and pushed this up all the way to the high of the day. Very positive. So if we go back to a simple analogy of you and your significant other are in an argument, and you're fighting about something, you can pick whatever topic it is. What's the most important word to have in that argument? It's the last word, and if you're like me, it's usually I'm sorry or, have some flowers. But really, it's the last word in this Japanese candlestick is, in this case, was buyers pushing it up. They're the power, and that's the momentum at that point in time. On the right side of your screen, you see the inverse of that, where at one point we had a string of buyers pushing this thing up, right? It was a nice green candle. It was a white candle, depending on which colors you use. I'll use red and green from here on out. But it was a nice green candle, and who knows why, but the sellers came back in and not only sold it all the way back down to where it opened, but even lower and closed it at the dead low. This is a sign of a very, very bearish pressure out there, and depending on where these candles happen, where they show up on a price chart, can give us some high probability trading factors. So let's look at these 6 candlesticks out here. Normally what I would do is I would ask you guys to quiz and say, oh, which one do you think is the most bullish? Which one do you think is the most bearish? Well, I'm going to just read through these and kind of explain them briefly. Number 1 is probably the most bullish, right? It opened at the dead low. There's no tail at the bottom of it. So it opened at the dead low, closed at the dead high. Very, very strong candle out there. Number 2, while you look at this one, you go, oh, well, it's red, so it's got to be actually kind of bearish, right? No, it's actually rather bullish because remember, just like the example we just looked at, even though the body is red, right, on number 2, meaning it closed lower than where it opened, it still closed at the high end of its range. And if I asked you who had the last word in that battle, it was the buyers, because it was, at one point, an all-red candle all the way down to this low, but for some reason those buyers pushed it back up, meaning the momentum was there at the end, therefore rather positive. Number 3 is, it's pretty bullish, right? It's similar to number 1, but it has topping and bottoming tails. A tail is this little part here, means it went down to that price at some point and it reached this high price at some point. So you'll call those tails, or wicks, or shadows, depending on who's instructing or using the candlesticks. Number 4 is actually rather bearish. Even though it's a green candle, psychologically we go, oh, green, positive, good. Well, not necessarily. Again, this is like what we looked at a couple slides ago, where you have a lot of selling pressure coming in at the end, pushing it down to near the lows of the session, therefore it's bearish. Now, number 5 and number 6, I would say, are almost the same. They represent indecision, very small real bodies, right? You can see number 5's got that small red body. Even though it's red, it still didn't have much of a change from where it opened to where it closed. Same thing with number 6. That's called a doji, where it opens and closes at the same price. The only thing that separates 5 and 6 is the range. So we had a lot more volatility during that number 5, whereas number 6 was almost non-existent, barely even moved. And those can also give us clues as to potential market direction. So let's talk about that number 6 for a second. That's the doji out there. What is a doji? Well, a doji is simply a candle that opens and closes at just about the same price. It doesn't have to be exact, but a lot of people, they're true technicians, say it's got to be the same price. Well, when you're trading something like the S&P and it's trading at 2,000 plus, it's kind of hard to get it to close exactly the same as where it opened. So we like to say ballpark, pretty close. And you notice that we have 3 different representations of it out there. You see one is just like a little tiny plus sign. You have the middle one there, which got some big ranges to it. And then you have the one on the far right, which is called a dragonfly doji. And I'll explain some of the differences between those as we progress. So let's go into some of the more popular doji patterns. And again, if you have any questions, feel free to send those in here and I'll go over them. Gravestone doji is one of the more popular ones. Now, a gravestone doji is simply something that opens and closes at about the same price. That's the classic definition of a doji. Now, for it to be a gravestone doji, it opens and closes at the low, or very, very near the low, and has a long topping tail. Now, by itself, this really doesn't help us make a trade. Location, location, location. You'll hear that heard all through real estate. You hear it with Japanese candlesticks as well. If this candle was at the top of a nice sharp uptrend, then it's going to give me a good probability that prices are going to be moving to the downside. So if this is a gravestone doji, which denotes selling pressure and maybe a more bearish environment going forward, well, what does the opposite look like? Well, here we have a dragonfly doji, which looks exactly the same, just upside down. You have prices open and closing just about equal. That's right near the high. And you have that long bottoming tail there. Now, again, location is key. If we had this happen at the top of an uptrend, that's really not that important to us. If it's at the bottom of a downtrend, and especially if we go back to Online Trading Academy's core strategy and talk about it into a demand zone, now we really have something that gives us some teeth to work with to a potential upside move. Now, what are some of the other ones out there? These are all called spinning tops, and really all a spinning top is a very short compressed range. A narrow range candle is what they like to call them, or NRCs. Generally what that means is you have a lack of emotion. So it stays in a very short trading range. You don't have much price movement, maybe some small wicks or shadows, tails above and below, but really it's not a lot going on, and it generally represents indecision. Now, indecision can frequently be found in areas of consolidation. So I've got an illustration here, and you'll see in that red oval there, there's a lot of little tiny spinning tops. And it's really where price was just going sideways. Again, doesn't matter what security this is. You'll find spinning tops a lot in sideways congestion, but you can also find them at points where price is accelerated aggressively and all of a sudden it just kind of stops. Those become great trading opportunities for me as well, because that indecision could lead to buyers or sellers' remorse, if you will, and we could see a reversal in price direction. So those are your spinning tops. Of course, we've got the tiny little narrow ranges. We also have these big, colossal, giant ones. These are, it just says long candle. I just think the name is terrible out there. I like to call them expanded range candles, really large ranges, meaning we've moved a lot in whatever time period this is, whether it's a 1 minute, 5 minute, daily, weekly, monthly, doesn't matter, but a really large candle. Now, obviously, that represents a large price move, a wide range. You generally don't have wicks with these, meaning it's going to be closing near the highs, opening near the lows, closing near the highs, and vice versa. What this represents is a lot of emotion. A lot of times you see these expanded range candles or long candles after major announcements, right? Could be an earnings announcement, could be some press release coming out, but there's a lot of emotion there, and generally it's coupled with a lot of volume. That's what's driving the price. So we can see on this chart, here's a couple examples of them. You see some really large expanded range candles. Now, again, it doesn't have to close at the dead low or open at the dead high, but it makes it more powerful if it does. And these 4 examples that I have here, you'll see that all of them have some topping and bottoming tails. So nothing with candlesticks is going to be perfect. It's a little bit of an artistic flair there, meaning it's kind of slightly subject to your artistic view on this one. And I'll show you some examples of what I mean by artistic view here shortly. All right, So now let's go to some of the more popular ones. Here we have the bullish harami, which in Japanese means pregnant. And you can see by the illustration on the right-hand side, you've got price drifting down. You've got a nice big black or red candle. And then the next candle is going to be most likely green. It's preferably going to be an up candle, but it doesn't have to be. But it is going to fit within the previous range. So as you guys can see here on the screen, you've got this black candle, and this entire candle, including the tails, should fit within the real body of the previous candle. That is really the definition of a bullish harami. So you've got the downtrend. The first candle is definitely a down expanded range candle. The second candle, maybe a little narrower range one, preferably to the upside, and it is completely engulfed by the first day there. So we can make a little modifications. And this is where I think Japanese candlesticks get rather humorous, because you have the bullish harami, and then you have, oh, the bullish harami cross. Well, what changed? You'll notice all that changed was the second day. Instead of it having a body, now it's just a cross, it's a doji. So it doesn't make it any more powerful or less powerful, but I wanted to include that here so you guys can hear. You may have heard some of these terms out there, the bullish harami cross or just the bullish harami. So how does this look on a price chart? Well, we can see very clearly here we've got two decent examples. Now, I know if some of you are masters of Steve Nissen's book on Japanese candlesticks, which of course is kind of the Bible for most people out there that like to look at Japanese candlesticks, you'll say, well, that first one on the left side isn't exactly a harami. Why not? Well, if you notice, I'm going to have the cursor illustrated over here on the left-hand side. You'll see we've got this, you can call that an expanded range candle, this black candle right here, and then we have this little doji. It's basically a bullish harami cross. But technically, you'll notice that the tail on the doji is just slightly outside of the highs of that expanded range candle. So technically, you could argue that's not a harami. But hey, it's close enough for government work. I'm going to call that one a harami, because you notice it was drifting down. You also have the similar situation here. We had price drifting down, and then you have this harami here. Even though it has a long tail on it, it still fits completely within this expanded range candle, and the next day we get basically 3 days worth of upside move. So there you see some bullish haramis on a price chart. Now I would say the sibling of harami is just the exact opposite, right? A harami is a big down day, and we have bearish haramis as well. We'll cover both those, but you have a big down day followed by a small little up day. Well, what if we have a small down day followed by a gigantic up day? These are called engulfing patterns. So this is a bullish engulfing pattern, what some would refer to, we talk about that in our XLTs, as kind of an outside day. And really what we're looking for here is a market that's been trending down. So remember, key is location, location, location. If you have an engulfing pattern in the middle of consolidation, it doesn't mean much. If it's trending down though, we've got a nice downtrend, and that first candle is kind of a smaller little doji pattern perhaps, but it's a negative down day. And then the second candle is this really big candle that it completely engulfs, meaning it eats up the entire previous day worth of trading. That is an example of a bullish engulfing. This is a great pattern from a reversal perspective. We see quite frequently what it represents is a change in emotion, a change in sentiment. So we have that big expanded range candle there. Prices most likely, and when I say most likely, it's not like a 90%, but you have a greater than 50% probability that's going to move into the upside, because where's the momentum? Where is that tug of war being won? Who's winning? The buyers were winning that day, and that momentum most likely will continue. For how long? Who knows? But it's there at that moment, and that's what's important. So here's a great example of a bullish engulfing pattern. You notice that going into this engulfing pattern here, we had pretty much a month of just almost constant sell-off, 1 month of just almost all down. And then all of a sudden we had a big bullish engulfing pattern, and it rallied for the better part of another month. In this case, went from 225 all the way up to about 255. So you're looking at a $30 move, about a 12, 13% move in a month on this stock. And what caused it? Emotion. How can we spot that emotion? By that bullish engulfing pattern that formed on that one. Now, here are some of the more obscure ones. Not obscure. You'll see them regularly on price charts, but it's just wanted to get you some wider scope as far as the different candlesticks that we're using out there. Here is one called a bullish doji star. Now, let me take a step back here real quick and say that you can torture yourself with Japanese candlesticks. You can basically come up with a name for any candlestick by itself, a name for any 2 candlesticks together, and a name for any 3 Japanese candlesticks together. I think Steve Nissen's book is 300 or 400 pages of exactly that. And I think that it was kind of throwing darts and saying, well, let's put this one next to this one, and we'll call that, well, that's the abandoned baby. That's the falling window. Some of them are just kind of outlandish. So what I'm covering you are the basic ones that have some meat to them and really some substance with regards to probability. And I'm hoping that I'm explaining the psychology enough here so you can see why it's so important. That not only are we watching what's going on with price, but the behavior behind price. What is causing that emotion to stir? And as if you know the kind of truth about financial markets, the institutions make money off of the novice investors. So if I can get the emotions of the novice investor and track that, then the probability is greater in my favor. So let's take it back, another look at this bullish doji star. All this represents is, again, an emotional spike. In this case, it's a spike to the downside. And you can see we've had this big, we're in a downtrend. The second to last candle here is a long, expanded range candle. And then the second one there gaps below the first candle. Gap meaning that there's airspace between these two. They don't overlap at all. That is a huge sign of sentiment, all right? It's an emotional spike. Now, of course, if we had volume on here, that might actually help with our confirmation. But that second, the final candle there, the doji shows it should be short, should be compressed. Now, again, I mentioned there's 2 candles. Everyone wants to say there's 2 candles here. Well, you want to add a third one? Now it's no longer a bullish doji star. It's a bullish morning star because in the morning you wake up, and in theory, this is where this price will be headed for the short term. Same thing, right? We've got that downtrend, expanded range candle. It gaps down, forming kind of a little island out there. Got that compressed narrow range, and all of a sudden, the third candle gaps up again, leaving this gap here. That is a very bullish sign called a bullish morning doji star. We've got 3 candles, and I got 4 words there. Wish I would keep it down to 3. All right, so now we'll go to a morning star. Right, so it's no longer a doji down there on the second candle. It's simply a small little, I guess you could call it a spinning top, but this would be called a bullish morning star. So really not much of a difference. The only thing that would have changed here is that little tiny candle in the middle, the very bottom one. So we got a question that says, does it have anything to do with supply and demand theory? Not that it has anything to do with it, but in conjunction with. So if we take the supply and demand theory and we are looking over, let's say, to the left-hand side of our charts, and we're spotting an area that we say, man, I really feel like there's institutional demand here. I can see it on the price chart, right? That's kind of the basis of core strategy. And if I can find those areas where there's a good deal of demand, and all of a sudden I get a bullish doji star or morning star right into that demand zone, does that make this candlestick even stronger? Hallelujah, it does, absolutely. So by themselves, they're good. But if you can use them and line them up with demand or supply, depending on whether you want to go long or short, then that really adds value to them. So by themselves, I think Japanese candlesticks are great. Using conjunction with supply and demand makes them exponentially better because the supply zones and the demand zones are where the buyers and sellers really are. And if the candles line up with those, then we have a very high probability trade. Great question. All right, so let's go to my personal favorites out there. This is one that I look for all the time. I actually run scans and filters on some of the platforms I'm looking for this candle. This is called a bullish hammer formation. Of course, we could flip this upside down, and this could also be a bearish hammer formation, but we'll talk about that in a second. It's called a shooting star. How do we identify it? Well, you remember at the very beginning, I talked about candles that have, you know, in one sense, this looks positive because it's a white candle, but even if that was a black top on it or red, it still would be bullish. Why? Because notice where we were. We were trending down, right? So it was in the middle of a nice big downtrend. We had a small real body at the upper end of that trading range, meaning at some point, this whole candle was black or red. It was negative. It was down. And the buyers came back in and pushed it all the way up near the top. Now, as I mentioned, the color of that body, whether it's red or green, isn't really important. I personally would prefer it's green because it really shows some positive sentiment, but it doesn't really matter. The longer shadow should be at least twice the length of the body. That's kind of key here. You want to have a very small, narrow range for a hammer formation near the top and little to no upper shadow. So you don't want anything up here at the top. This is a tiny little one. That's okay. But you don't want to have this kind of sitting in the middle. The real body sitting in the middle. That would really be just nothing but a doji or a spinning top. So where do these form? Well, again, for me, when I see them at the bottom of a downtrend. And of course, we don't know that the downtrend is over, but if I can spot it into an area of demand, that makes it a very high probability trade. So you notice the candle in the middle here that's circled in red. That is a hammer formation. Now, unfortunately, there's nothing for us to look to the left and see an area of demand on this one. So I don't know if it coincides with an area of demand, but you can see that clearly the next day, nice bullish up move, right? It had a great move, and actually for the next couple of days, shot up significantly over the next 4 days. Well, notice on the hard right edge, we have another one on the right. Now that one actually formed a hammer formation after an aggressive sell-off in price, and it actually came down to those previous lows that you see in the middle of the screen. So now I start to feel more confident about this specific candle. Now the only caveat to this is they are lagging, right? If I wanted to trade this candle on the right edge that the cursor is spinning around right now, if I were to buy it now, I'm going to be buying up here near the top, which looks to be on this chart right around 77. Okay, I'm going to call that 77. But could I have bought down here at 75.50? Yeah, possibly, right? I need to break down this candle and see where that actual demand zone was and see if there's an entry point. So candlesticks can be lagging, right? So if you buy this hammer formation, for example, you're leaving some money on the table. So I always, number one, I'm looking for supply or demand zones to make the trades. And if I get a great candle forming, I might add to a position based off of that Japanese candlestick formation. So here's the inverse of that, right? We looked at the morning star. Well, here's an evening star, right? In the morning, you get up. In the evening, you go to sleep. This is an example of that. We have an uptrend going on, so you got a nice upward rally in the market or the security, whatever it is. That first day is going to be a long white day, right? An expanded range candle if you want. Second day, gaps above that first day's close. So it's gapping outside and forming maybe a doji or spinning top. And then that third day, gaps down and proceeds to sell off. Great high probability reversal formation out there. And of course, we could change this very quickly. All we have to do is make that top pattern there, that which was a doji. We just make that into, or sorry, a spinning top. Just make it across. Now it's a bullish evening doji star. Why? Because the doji. Not much has changed here, but you guys can see that the basic psychology is the same. Now we looked at bullish engulfing. How about a bearish engulfing formation? Some that you probably have seen in the last couple months here in our markets. Same thing, right? We've got the uptrend going on. So for it to be a bearish engulfing, we want to be in the midst of a nice big uptrend. This is a potential reversal formation. So we've got the uptrend happening. That first candle, a small little spinning top if you want. Could be a doji as well. The second one gaps up above it, completely engulfs it. You know that this black candle here completely eats up that previous day. That is a bearish engulfing, and there's a good chance this could be moving more to the downside. Again, to go to Yoga's question, if this was into an area of supply, all of a sudden my confidence in this trade is going to be much, much higher. I'm looking for that extra little probability to put in my favor. Now, we talked about the bullish harami. Here is an example of a bearish harami formation. Just the opposite, right? We're looking at an uptrend. Prices are moving to the upside here. You've got a nice expanded range candle, which really brings in a lot of new buyers. That's what caused that expanded range candle there, that white one, or in most cases going to be green. The second part gaps down a little bit. Narrow range candle. Kind of shows a little bit of consolidation, some pressure there that really shows indecision. Well, if you had a big uptrend, and let's just think of it from a psychological perspective, if you've had a big uptrend in price, and all of a sudden you get this really big expanded range candle, I think that we could agree that it might have exhausted itself. And that's generally the principle behind this harami formation, is you've had an up move, you get this nice big surge, and that forms that first big candle there. That could be retail investors piling in, acting emotionally. The next day, because most of the buyers have already bought, it gaps down a little bit and hesitates. If momentum was truly strong, what should it do? It could gap down and then continue to rally. But in this case, it stays compressed, shows a small little range there which represents indecision. So really, that is not our time to open a short position or to sell out necessarily. It's really about waiting to see what happens on the next candle. If we start to see new lows being made, okay, great shorting opportunity. But it could very easily start to rally back up. That second candle there just represents indecision, a hesitation moment after a big thrust to the upside. Now, if we just tweak this a little bit and we take that and we make it a doji, now you see we've got a bearish harami cross. Going back to our quick naming of different candlestick formations out there. And there, again, there's thousands of different ones. So my personal favorite was the hammer formation, and that goes very well with its kin, the bearish shooting star. It's basically the same thing as a hammer, just upside down. Now, what we're looking for here is a security or a market that is trending up. You've got a small real body generally at the bottom of the trading range. The color of that body is not important. In this case, you see it's white, right? It could be green, could be red, whatever color, not that important. If it's a shooting star, I would prefer it to be red, meaning it closed at the dead low, but it's up to the eye of the beholder there. Again, real small body, the bottom of the range. The color is not important. The long upper shadow is what is important. I love it when I see really long topping tails on shooting stars. It represents more emotion because remember, how did this pattern form? At some point it opened, it rallied all the way up to these highs, so it was a giant green candle, and then the sellers had that last word, pushed it down, and it closed near the session lows. So it's very negative. Now, if we look at this on price charts, you guys can see here we've got a couple of them out there, and there's only, I would say, two that I find that for me would be very important. The one on the left, it is a shooting star, but you see it's not a high. Like this one doesn't really do it for me. It is a shooting star technically because it's after a big rally, but the candle before it kind of erases the power of it to me. Yes, it did follow through and had a great sell-off, but you know we're all what do they call it? The Monday morning quarterbacks. We can all after the fact make assessments about it. This one here in August was pretty decent, but notice it rallied up and it was just going sideways. So I probably would not have been looking at that one as a short entry. This one here, though, I'm a little bit more inclined to look at these two on the right side. You can see that they weren't quite new highs, but they kept rallying up into this area of overhead supply. You see for 4 days, whatever time frame this candle is, it really just kept hitting these highs right around $84. So the fact that it shot up and kept getting crushed back down for 4 consecutive days is actually very bearish. This would have been a great trade. And of course, in hindsight, we can see there was a significant move out of it. But all it was doing was alluding me to the behavior and psychology of the buyers and the sellers. This right side is a great example of that psychology. Most people would look at this and say, well, nothing's really happening. Absolutely there is. Those buyers were trying to push this up because the momentum was up and they kept getting crushed. Day 1, they got slammed back down. Day 2, slammed back down. Day 3, they really got crushed. They tried to rally on day 4, again got slammed back down. Day 5, again got slammed. So if you don't see that selling pressure out there, the fact that sellers are unloading for whatever reason, you need glasses. This is a clear example of that psychology in the marketplace pushing things to the downside and really set up nicely for this big sell-off. All right, so that was a very, very quick overview out there. Maybe in future sessions we can talk more about strategy and tactics on this, but what I wanted to emphasize here is that this is not a standalone trading instrument. This is a decision support tool. So if we're out there looking at price charts and you see a great shooting star or a great harami, fantastic. Mark it down, make a note, look over to the left, look and see if there's any area of supply or demand which could make that pattern more significant. Likewise, if you have an area of demand that you've already mapped out, and that's kind of the way that I operate, is I will look for good areas of demand, good areas of supply on my normally traded instruments, and I've got those levels mapped out. And if I see a candlestick formation start to form in that zone, well, now it makes that trade even better for me because I'm, again, using the candles, which is retail, generally retail and behavioral psychology, and the institutional levels, which is looking at the supply and demand zones. Put those together, make myself some great trades. It should be designed as an odds enhancer, meaning if we take the whole spectrum of things that we're using to build our trades, start with number 1, which is price, looking at supply, looking at demand, mapping out those zones. And then we start to add in qualifications. Our odds enhancers generally look at how price move, what the characteristics of it look like, and that is our odds enhancers. This is one additional one. Add on candlesticks. You might even use some technical indicators, but again, they should not be the foremost decision-making piece. Why? Well, partly because they're lagging indicators, right? They're reactionary. They're showing you what happened between buyers and sellers, and that could give us clues as to what might happen going forward. But again, it's a reflection of actions that have happened in the past. Really that window into psychology. So, Donnie, great question. He says, when using support or resistance, is it best to use the body or the wick? The wick. Remember, if we have a support zone and you have, let's say, a hammer formation that has come down into, or say, a demand zone, and you have a candle that's come down into that demand zone. If the body's in the demand zone but the tail goes down below the demand zone, that demand zone's violated and is no longer good. So if you have a formation that is the bottom of the tail tips down and just kisses your demand zone and then starts to rally up, well, you should be in the trade because it hit your demand zone, right? That's point number one. But all of a sudden that day ends or that bar ends and it's a really big hammer formation. Could you add to that trade? Could you put on a little bit more there? I think so, and that's how I operate. I'm trying to use supply and demand first, get that trade, and then at the end of that, if the candle forms and it looks like a high probability that's going to move to even further in the direction that I decided, then I'm going to add more to it if it does transpire that way. So I'm going to use the wicks out there. Great question, Donnie. All right. That will do it for this session. That was a quick overview. Again, we do talk a lot more about these in other sessions, so I would encourage you guys to check out the OT Academy website, not just for candlesticks, but basic investment methodology as well. There's a lot of free videos out there. I would encourage you to send them in. And if you like this video, share it with your friends. There's also down at the bottom at otacademy.com a little feedback page. We'd love to get your feedback out there and send in ideas you want for some new topics. Until then, guys, happy trading, and I will see you on our next session with OT Academy.